Well, good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute, coming to you from the Palm Springs and Greater Coachella Valley area. Of course, as we start the program, I do want to comment again about the recent wildfires. It appears that we're at least past the worst of it, but at the same time, we all want to keep all those victims in our thoughts. And not only that, but see if you can do what you can to support them with the various charitable efforts that are being made, Red Cross and so forth. And today I want to point out that we're going to do something a little bit different with the program. I am going to go ahead and get right into a rate update, but we're going to have a little bit more of a conversation about things like that. So I'm going to bring Jeff in now so we can start the conversation.
Hi, Art. How you doing?
Hi, Jeff. Good. How are you?
Good. I'm excited about today because I get to ask questions on air that I typically ask off air.
Okay. Well, yeah, that's good. Let's try that out. I think it'll work well.
Well, I think first of all, we've had a very turbulent, I would say, beginning of the new year with the election and everything's going on. We've seen the rates go up and down, and watching that 10-year. It is like watching lightning. It strikes and it goes up and it goes down. Tell us about that. And I know that a lot of people think, okay, I've heard Art say this before, but for those people who haven't heard, how important is that 10-year?
The 10-year, I think, and I tell people this, the 10-year bond yield, I think, is critical if you want to have a handle on the direction of mortgage rates in both directions, of course. Again, there's this belief in the general public that the Federal Reserve should be the focus, that whatever they do in terms of decisions on raising or lowering the Fed funds rate is going to directly correlate to mortgages. And time and again, we've seen evidence that that's not how it works. And so this week is a good example, this past 5 days for sure, is a good example of how it's not so much about the Fed per se, but about the 10-year Treasury bond yield. Jeff's just pulling up our rate grid right there. And actually, when you look at these rates, they're actually better, almost up to about 0.25% better than they were just a few days ago and going into the end of last week. And there's a variety of reasons for that. You're looking there at a conforming loan is now back to around 6 5/8. Earlier this week, we were just about at 7%. And in the news media, of course, it talked about a lot of lenders had broke through the 7% barrier. We did not. We were able to go, we got up to 6 7/8, but now you can see that we've come off of that. And so this is a good example of how mortgage rates can move around pretty significantly in a relatively short period of time, just day to day and sometimes even intraday. So in terms of what's happened the last few days and going back to last Friday, well, of course, last Friday we had that big, strong jobs report. And so if you look at this 5-day chart going back to last Friday, that reflects what happened. Last Friday, that jobs report came out and the 10-year bond yield shot up quite a bit. And, from there to the early part of this week, we actually broke through the 4.80% level. Now, since then, you can see that nice slope downward to where we're at now, which is more like 4.6%. So that's about a 0.20% improvement in the bond yield. And as a consequence, mortgage rates followed in that same direction. Now, what happened after when that very strong jobs report came out, the narrative immediately changed. It's like, okay, the Fed's not going to lower the Fed funds rate 4 times this year. They're going to move and only move that back to maybe 2 times for the year of 2025. And then the narrative even went more extreme to say, well, wait a minute, that jobs report is so strong. We think now there may be no Fed reductions in 25 at all, and that maybe the Fed will raise the Fed funds rate. So that was pretty startling. Well, luckily, that narrative dissipated pretty quickly because what happened this week, the primary data points that came out this week were the inflation numbers, CPI, the consumer price index, and PPI, the producer price index. That's retail and wholesale inflation. The PPI actually came out first, and it was what they call cooler than expected, slightly below expectation. And then the CPI came out the next day, and like the PPI, again, consumer price index, retail inflation, it also came out cooler than expected. So that gave the market some optimism. And of course, that was reflected in that downward slope in the 10-year since Wednesday. And so that was good news. And of course, see that's how you can see this change in direction almost on a dime, just based on the latest economic data that was released. So now we're back to, I think, the idea that the Fed's going to raise the Fed funds rate this year, or at least soon, looks to be off the table again. Now we're back to maybe they're not going to lower right away. Maybe there won't be two reductions this week, but at a minimum, it looks like they're going to pause. So that's really what's been causing this change from last Friday to now. And of course, overall, it's good news. It's a little bit of a, we were holding our breath, and now we can kind of exhale and feel a little bit better, like that big increase is off the table. Now, next week's going to be interesting because the economic data point calendar is very light. There's virtually nothing going on in terms of economic data being released. So that overall should be good news. Hopefully it'll keep the bond yields relatively muted and moderated so that we don't see any big jumps. And of course, Monday is a federal holiday, so that means we've got a little bit of a short week as far as the financial markets go. So,
well, I'm curious, and I'm just going to take us back just a little bit, because I noted before we went on air that your rates have gone down, and I noticed down here, which is affected by the federal fund rate, is this fixed rate, the HE loan. Tell us about that, because that's now broken through that 7% barrier. Is that correct on the rate?
Yeah, that's true. One of the things about equity loans in general, and of course for our viewers, HE loan means a fixed rate second mortgage. That's where you get a loan in second position behind your first mortgage, which of course these days is likely to be in the 2 to 3% range. So you'll get the second mortgage that's just a traditional fixed rate loan. You can have a term anywhere from 10 to 30 years. 20 years is a good option and very popular. But the HE loans and the HELOCs, which of course HELOC is a variable rate loan, except for one product we have that's a fixed rate HELOC, very unique. But both HELOCs and HE loans, given that they're generally shorter term loans, shorter in terms of, again, 10 to 15 to 20 year terms is very common. Those are going to be a little bit more impacted by what the Fed's doing with the Fed funds rate. And our one of the lenders that we use for HELOCs and HE loans, they've had an interesting change in their rates over the last 30 days. Their fixed line HELOC was very aggressive in terms of how it was priced just a month ago. They've actually raised the rate on that, but yet their HE loans actually got better from a month ago. And that's, as you mentioned, Jeff, they broke through the 7% barrier. You can actually get one, down in the high 6 range. So, I can't emphasize this enough for homeowners who have a lot of equity. And if you're deciding to stay put, you're not going to sell and get another home. And if you want to stay put and maybe do some improvements to your house, or you've got to consolidate some debt after you spent too much money over the holidays, or maybe add that ADU to generate some more rental income, the equity lending, the HELOCs and the HE loans are a terrific opportunity right now in this current environment.
Well, I love the fact that we do have that movement. I'm curious, as we look at something like this, if I were, let's say, if I were in the process of buying a home, and there's this much volatility in the rates, what happens if I'm back here, let's say this last Friday before it went up? Can I lock in that rate, and then even though all this stuff is happening, I've already locked in my rate, or am I subject to this movement as well?
Well, the way that works is, and that's a very good question. The first thing I tell people is when you're going to lock in a rate, you got to think of it like buying a stock. Maybe you've been on the sidelines, you've got your eye on a particular stock for a company, and you want to invest in that company. So at some point, you got to make a decision. When are you going to strike that purchase and buy the stock at whatever the stock price is? Now, once you do that, you're done. I mean, you can't go back if the stock price falls a few days later and go back to Charles Schwab and say, hey, that stock buy I just did on Monday, never mind, I didn't mean it. I want to buy it today at the lower price. It doesn't work that way, obviously. Well, a mortgage lock-in works in that same fashion to a degree. What do I mean by that? Well, for example, Jeff, as you said, what if you locked last Friday and you're in escrow on a purchase transaction, you've got a 30-day escrow. And so if you lock last Friday, again, you've made that request, the lender has honored that request, and you've locked in a rate. So what does happen if mortgage rates after that do start to improve? Well, most lenders now have a renegotiation policy, meaning even though you're the one who asked for that rate lock, which of course does set your maximum rate. You've established a ceiling, so at least you don't have to worry about rates getting worse after you've opened escrow. But in a case where the rates then get better after you've requested that rate lock, you do have that opportunity to go back to the lender and say, you know what, I see the market's improved. I'd like to renegotiate my rate lock. So how does that work? Well, generally speaking, what a lender is going to do is they do have some parameters. There has to be enough of an improvement in the rate market over what you locked at. Generally, that's going to be about 0.25%. So let's say last Friday you locked in at 6 7/8 on a conforming loan. And then here we are Thursday the following week, and as you saw from our rate grid, you're at 6 5/8 now. That's 0.25% improvement. So we go back to the lender and say, okay, we want to renegotiate the rate lock. What they'll do is they say, okay, we will do that. There's going to be a fee involved, and it's typically 0.5% of your loan amount, 0.5 point. And so that would allow you to take that locked rate of 6 7/8 and move it to 6 5/8. Now, 0.5 point, depending on your loan amount, is a good amount of dollars out of pocket. Now, some borrowers may not want to pay that out of pocket as additional closing costs. So the alternative is to essentially finance the cost of that renegotiation fee into the rate you're renegotiating. So for example, using the same example, you locked at 6 7/8 last Friday. You want to renegotiate the rate today because it's 0.25% better at 6 5/8. You're willing to pay that fee, but you don't really want to pay it as additional cash in your closing costs. So what you can do is split the difference. You can take a rate at 6 3/4. That's still better than the 6 7/8 you locked at last Friday. And then that 0.5 point renegotiation fee gets absorbed in that 6 3/4 rate, which is slightly above current market. That way it's kind of a win-win. You're able to break your rate lock that you initially requested, get a slightly better rate, but you don't have extra dollars out of pocket for that renegotiation. So that's typically how it works.
Oh, that makes sense because I would think, I mean, you've been doing this for over 4 decades. I mean, it's probably that moment of like, is this the best time? Should I lock it in? Should I not lock it in? How do you counsel people to make that decision or help them, get the facts straight? So I guess ultimately they would be making a decision. What kind of conversation do you have during that point?
That's a good point. And I have those conversations quite a bit. And one of the things that are different now versus decades ago. Back in the old days when I first got in the business, we didn't have these renegotiation options when you did a rate lock. It was pretty much a done deal, and you just couldn't go back and get it renegotiated. And sometimes we'd have borrowers who frankly would simply walk away and take their application to another lender because they didn't have that renegotiation option. So lenders got wise to that and realized, on the one hand, they feel like a deal is a deal. It's the borrower who requested that, and so they think the borrower should, live up to that agreement. But at the same time, they're not naive. They know that people have that ability or did have that ability. Just go to another lender and start over. So one of the things I point out to people now, because it is very difficult, the rate lock decision can be very, very challenging for a borrower, particularly those who are not real privy to the financial markets and how all this works. So it can be really, they're wringing their hands as to when is the best time to do this. So I do try to counsel them on that. And one of the things I point out, particularly even in a short escrow, you're a 30-day escrow, it's usually not going to make a whole lot of sense to play the market, because you have some notion that you think even though rates are where they're at today, that they're going to get better for some reason. And of course, what we've learned recently, a lot of people get into that mode of thinking if the Fed's got an upcoming meeting and the predictions are they're going to lower the Fed funds rate, a lot of folks get kind of tied up thinking, okay, I opened escrow, but I don't want to lock my rate because I think the Fed's going to lower the Fed funds rate, and I think that's going to help mortgages. Well, we now know and I've always known that's very dangerous strategy. You don't want to do that. So what I counsel people is understand that you do have the renegotiation option. We didn't used to have that. So if you've opened escrow, you got a 30-day escrow, you don't have a lot of time there. If we've qualified you at current rates, I think, and I typically tell people, you are best served to go ahead and lock the rate at the outset. Why would you do that? Because for one, it limits your maximum rate. You've established the ceiling. So you know it will not get any worse during your escrow period. Yet you have that option if there is improvement after your initial rate lock and before your escrow is closing, you do have an option to renegotiate the rate. Now, that's usually a one-time option. So then you still have the challenge of, well, if things are improving, at what point do I do the renegotiation request? You know, if we've improved a quarter in rate after, say, a week, as we just showed. Well, what if you wait another week? Maybe it'll be a 0.5% better. So you still have that process to go through as to when is the best time to strike a renegotiated rate if the trend is going down. Because again, what you don't know is how long is that trend going to continue going down, and can it snap back up, which it can. Again, it's all based on what's the next economic data point. How is the financial markets interpreting that next data point? Is it going to be helpful to long-term mortgages and the bond yields, or is it going to hurt long-term mortgages and bond yields? And depending on how the financial markets react, that downward trend can suddenly snap back up, and that renegotiation opportunity may go away literally within a day. So again, it can still be challenging, but overall, again, if you have a short-term escrow, or if you're doing a refi, most refis only take 30 days. I don't think it makes a whole lot of sense to play around with deciding to play the market and time the market because you think it's going to get better during your escrow period. I think it's always better lock up front, knowing that you have that renegotiation option in your back pocket to use when you need it. And part of what I do is I do a lot of conversations with my borrowers to at least give them my interpretation about what's going on in the financial markets and the bond market, economic data points, and how those things can affect your rate. So I at least give them that information. Again, it's just my opinion, but I've had some pretty good practice with this. So I'm not perfect. I can't predict the future like anybody else, but I can give them a little bit more insight of what to think about in terms of financial markets, so they're better informed for what ultimately is going to have to be their own decision.
Well, you know, this reminds me of a story that started last year, and you had somebody playing, I'm going to call it rate chicken or rate roulette. And, you know, it feels like if I'm going to be getting into the housing market, there is a sense of urgency, it sounds like. And I want you to tell us about those people who said, you know, hey, we're going to wait until such and such a thing because we have a target that we want to get to. And then tell us what happened and the result of that.
Yeah, that it turned out to be a very interesting story. It was a homeowner who approached me about a refinance. She did alert me that they had used another originator on multiple occasions in the past, and that they were in discussions with that originator to refinance their property. But, you know, she had heard about us and our services and had gotten good feedback about what we could do. And so she reached out to me to see what I could do in terms of, you know, competing with her lender. And so I asked a few questions. And one of the things I found out early on in the discussions is, frankly, I was startled by what she was being told as to what's possible in terms of a refinanced rate. Now, they were on an adjustable rate mortgage that had adjusted and was up close to 8%. And at the time we started this discussion, mortgage rates had improved a fair amount. In fact, this was at a period when we could do a refinance of a conforming loan and offer a rate a little bit under 6%. Wow. And when I told her that, she was skeptical because she told me they had been offered a rate at 7%, but it was at no closing costs. And of course, in their mind, that was a benefit because it was almost 1% lower than what their ARM loan had adjusted to. And I'm careful not to criticize the competition. I was relatively forceful about telling her that they were essentially getting ripped off, that a 7% rate in that environment at the time was way, way above market. And one of the things I pointed out was it underscored the fact that that originator, who I believe was a broker like we are, was offering that rate because they had a much higher lender paid compensation arrangement with the lenders they delivered loans to.
Mm.
Because as we've talked about in the past, as a broker, we get paid by the lender, generally speaking, and we have to declare in advance how much we want to get paid on each loan. And the range goes from 1% up to 2.5% of the loan amount. Well, our lender paid comp with most of our lenders is at 1%. So I suggested to her that if she's being offered 7%, that broker's lender paid comp must be substantially higher than ours, and that he was probably getting compensated at least double, if not more, than what we would be willing to be compensated for the same transaction. So I provided her a written closing cost worksheet spelling it all out. The rate was 5 7/8. There was no points, no origination fee, no lender fees, no broker fees. I sent it to her. Initially, she didn't react to it. She actually thought that I wasn't being truthful with my quote, and in part that was because the other brokers in her ear saying, "Hey, that can't be. That's not possible. They can't do that. There's no way they can do that." And then I guess she did some other checking around. Same thing. She found she couldn't find any other rate quotes out of there online or wherever that matched what I had to offer. And then I ended up finding out that she, in fact, had gone as far as applying with that other broker, and they actually had an appraisal done. And then things moved away a little bit. Then it came back again. So I took another run at her. Hey, it's still here. Here's the worksheet again. I can still do this. At that point, they were willing to give me a try. And of course, part of what we did is, which is not well known with the consumers out there, is that we had the appraisal transferred to us. So she didn't have to get another appraisal. And then as a consequence, we were able to go ahead and follow through in getting that loan done. Now, we ran into a problem during the process where it turns out they had solar with that company that went bankrupt over the summer, SunPower. And there's a particular document we have to get from a solar company to subordinate to the refinance. Well, there were horror stories going on where SunPower was taking weeks and weeks, even a month or two to provide that. It was jeopardizing our closing because we had the rate locked. We were approaching the rate lock expiration. So I had to take some extra steps to talk to the title company, see how we could get around the documents we needed from SunPower. They were able to provide us a supplement to the title report that allowed us to continue with closing. And the only other thing I had to do is I had to go to the lender and basically request, frankly, beg and plead to give us an extension on the rate lock at no cost to the homeowner, the borrower, due to the reasons of SunPower being bankrupt, et cetera. And thankfully they agreed and gave us the extra time we needed to close that loan, so that their locked rate terms didn't change, and they got what we promised. And so it worked out very well, but it was not without those challenges.
Well, that kind of brings up this whole idea in my mind of like, hey, what are the expectations and what is reality? And I know you have a little bit different process than, especially since you just described what happened for one of your clients with another lender. If you could kind of set the expectations, if I were coming in as a brand new potential client, my wife and I are thinking about buying a home, and we just meet you for the first time, kind of take a second and walk through what you do with us to help us move along that path.
Yeah, good question. In fact, I actually have, as it turns out, and you don't even know this, I have a prospective home buyer, a married couple, and their small child, their toddler. They're going to be here in my office at 4:00 today. And they're coming to see me to talk about they're interested in buying a home. And so one of the things I always do, and I'm going to start with them as well, is when I meet with them, I'm going to ask them some very basic questions. What is the price level that you would like to buy at? You don't know yet if you can qualify, but if you had your wish, what price level would you like to buy? Is it 500,000, 600,000, 700,000? What is it? The other question I'm going to ask is, how much do you have in the way of down payment funds? Give me some idea what you have available or not available. so that I can, understand what they can do in that respect. And then the other thing I'm going to ask them is the property type, whether it's going to be a single family home or a condo. That's important because that does affect how the loan is priced when we're talking about a condo with less than 25% down. And then the last thing I'm going to ask them is, give me an idea what you think your credit score is going to be. And the point of doing that is, one of the things I've noticed in the industry for years is how many people get with a lender, and they may even be persuaded to submit an application to a lender before they find out any specific terms that might be available to them. Some lenders, particularly larger ones and bank lenders, they'll make the argument that, I'm sorry, I can't give you any kind of written estimate until you submit an application and I collect 6 pieces of documentation, including income and assets and so forth, and pull your credit before I can give you a loan estimate. Now, a loan estimate in the last few years is an official disclosure document created by the CFPB. We call it an LE. So if you go to a major bank and you want an estimate of what the terms are going to be, they'll say, sorry, I can't give you anything in writing. You got to apply. I got to get all your documentation. I got to pull your credit, and then we'll give you an LE.
Wow.
See, I don't like that. I've never liked that. I don't think it's necessary. So by asking those questions I just mentioned, I can at least start off with providing a written, detailed, it's not a loan estimate or LE. It's not an official disclosure document. It's called a closing cost worksheet. And right at the header, it'll say, this is not a loan estimate, and urging the borrower to get one from whatever originator they're talking to. But in the meantime, it gives the borrower tangible, real numbers, including an APR, annual percentage rate for the rate quoted. And I'll explain to them, look, this is not an official LE, but based on the parameters you gave me, this is what's possible. So you have a good idea going in what kind of terms you're going to get in terms of total closing costs, down payment amount, interest rate, monthly payment. So you see that up front. So in my mind, what you're getting is you're getting the potential price of your transaction even before I take your application, and then determine if you can qualify, and then maybe get your file registered with a lender and get the official LE. I think that's very important. I think it gives people the information they need to understand, number one, are they realistic about their home buying goals? Or with my help, do we need to adjust those goals in terms of maybe a lower price, a different property type, tweaking the down payment, getting a closing cost credit from the seller, and so forth. So I think that's something that we do that's pretty unique in the industry.
Well, it kind of makes me think, I had this vision of me walking onto a car lot with my wife, and none of the cars have prices on them.
Right.
How can I make a decision if I don't even know how much the automobiles are? And in your case, it's like, how can you or me, this couple coming in, how can they make any kind of a decision until they kind of have an idea what they can truly afford based on those few questions that you ask them?
Well, exactly right. And that's what I say is, I've encountered people, prospective buyers, borrowers, countless times who've started with another lender. Maybe they got unhappy. Maybe there's some trouble getting them qualified and so forth. And one of the first things I say is, did you officially apply for a loan? Well, yeah, we did. Well, did you get any kind of written, disclosure, whether it's the actual LE or some sort of closing cost worksheet up front, so you kind of had an idea what kind of terms you're applying for? You'd be surprised how many times people say, well, no, we had some verbal discussion, but I never saw any written numbers. And that's what I think is so unfortunate in our industry, is that I think you should get that kind of information up front. Now, of course, I have to provide, and I'll do this at 4:00. Look, this is based on what you would like to have. So understand that once I get your information and go through the qualification process, these terms may change. If I pull your credit, you told me you had a 780 credit score. I pull your credit and it's 665. Well, just understand that's going to change the rate. And if you decide that you don't want a single family home and you got to go the condo route and you're going to put 10% down, understand that could change the rate. So I make sure that they understand those things can affect what I'm initially showing them, but I think it's important to show them, at least initially, what kind of terms may be possible.
Well, I think this is important from a standpoint for people out there who maybe are in that process, like this young couple coming in or this couple coming in at 4 o'clock, is what can you expect to happen when you go there? And if it's if it's going there to any other lender besides you, and I'm not saying all the lenders don't do what you do, but as you say, it's pretty unique. And I walk in, and when I leave there, I still have a lot of questions that have not been answered, and I have no document to say, Jeff, you and your wife can do this, and this is an explanation, and it could change upon further, but at least I have a ballpark of where we're at.
Well, right, and that's the whole idea, is give them an initial ballpark. And as to your comment, it's not like there aren't other originators that do what we do in terms of providing that up front. I just don't think is as commonplace as it should be. And so the idea is we're going to give them that initial set of numbers, to provide a ballpark idea of what it would, what the terms would look like for the scenario they're telling me they would like to have. Then what's going to happen is once I get their documentation, and then I go through the formal pre-qualification process, including pulling their credit report, I'm going to immediately go back to them if there's going to be a change triggered from what I initially gave them, and then give them another worksheet and say, okay, I got everything here, and you can still qualify for this loan amount for this purchase price, but your credit score, as I mentioned earlier, isn't quite what you thought it would be. So guess what? Here's a revised worksheet, not an LE. So now you have a better idea, or even better idea, what the terms are going to be, because I now have your actual scores, which are critical to determining how the loan is priced. And by the way, that can work both ways. I've had cases where they'll say, oh, I think my credit score is only 698, so I'm worried that I'm not going to qualify. And then I pull their credit, and I find out, well, no, you're not 698, you're 764. So your pricing on your loan is going to be a lot better than we thought initially, because the score you gave me turned out to be too low, which, by the way, that can happen fairly often, because most consumers, they have a sense of what their score is, but it's usually from sources that are not directly related to mortgages. They'll get it from Credit Karma or from their credit card company, and those scores use different scoring models than mortgage credit reports. And so there can be a variance from what the consumer thinks their score is based on those other sources versus the 3-bureau mortgage credit report that we pull.
Art, before we move on and wrap things up for today, I'm just curious, is this, the fact is that, hey, you sit down and counsel with people, you give them something that tangibly they can look at and help them make a decision. Is this a knockout factor if I do go to a lender and we don't go through these steps? That maybe it's like, I'm not saying they're not a good lender, but it's like, wow, I'm still in this fog when I leave those lenders who don't offer that. Could that be a knockout factor in your estimation?
Well, I think that's a personal decision. I mean, obviously, I know people would argue I'm biased. I'm an originator. So they're going to probably expect me to say, yeah, that's a knockout blow. Why would you deal with that lender if they're not willing to give you at least some semblance of initial indications of what the numbers are going to look like, without forcing you to submit a formal application and provide, all your documentation first? I personally think that's a knockout blow. If it were me and I'm getting a mortgage, if I can give you those basic parameters that I desire and that I think I meet, if you're not willing to give me, essentially a price quote, I don't think I'd want to do business with you, because you're pulling me into the process without being fully informed, at least as to what could be possible. To me, that's a deal breaker. I'm going to go to the next one who is willing to do that. Now, not everybody thinks that way. So I'm not going to say that thinking you're still okay to work with that major bank who doesn't want to give you anything in writing until you submit an application and send them 100 pieces of paper. I'm not going to say that's wrong necessarily. I just don't think that's advisable. I think you're always better off get a pretty good idea what the numbers are before you get into the formal process. I only think that's fair, and I think it's more reassuring to that borrower, and it helps manage, frankly, their expectations.
Well, before we go on to the next piece, I want to put your information on screen because, first of all, you have a 1% broker fee which, as we said earlier, that could save money, and it makes a big difference in rate of how you as a lender gets paid from the broker, or
Correct.
excuse me, from the lender. And then also the fact that you offer lending. I know you said we're here in the Coachella Valley, but what is your territory? Where can you actually make loans?
Actually, a good question. We make loans all over California.
Okay.
We're a California DRE licensed mortgage broker. So as a consequence, being licensed in California, I can make a loan anywhere in California. In fact, I have a purchase loan in process right now, and it's on a new construction condominium in Morgan Hill, California, which is in Santa Clara County in the northern part of the state. I closed a refinance loan a couple of months ago in Weaverville, California.
I
Which
don't
is
know where Weaverville is.
Yeah, that's also up in Northern California. So, and we do loans, and I closed a private money purchase loan on a condominium in San Diego here just recently. So, anywhere in California, we can help a borrower, either a homeowner who's looking to refi or somebody looking to buy a home. So that's our territory.
Well, the reason I brought that up is, if I'm a real estate agent and I sell here in the Coachella Valley, I'm probably not going to sell in another area only because I lack local market knowledge. Is that such a critical factor when we're talking about lending?
I think it's less so. Although, we do run into that a little bit in the Coachella Valley, for example. One of the things about the local real estate, licensees here, they'll get worried if they're, say, have a listing, in Palm Springs, and it's on Indian lease land. And the buyer who comes in to make an offer is using a lender in LA, who boasts that, hey, no problem, we can do lease land. We're fine. We can make this loan. And then at the 11th hour, the listing agent finds out that no, that LA lender can't follow through and make the loan because they don't understand the Indian lease land process. So there is some of that can occur. Over my years of experience, I've got experience throughout the state of California, so I understand things about Northern California. Like, for example, they don't have independent escrow companies. So how the escrow and title process works up there is a little different than down here. I'm familiar with that. But yeah, you're right. I mean, a Palm Springs realtor generally is not going to try to list and sell a home in San Francisco. In most cases, they're going to refer that, if they even have that opportunity, they're going to refer it to a local agent and usually work out a referral fee. Lending, that's less needed, but in some cases, depending on the local market, like ours here in Palm Springs, where we had that Indian lease land, that's very unique. So having a local lender here for that type of property is going to be to your benefit in most cases.
Well, if you're just joining us, what we've been speaking about today is really kind of setting the expectations. If I'm somebody who's thinking about buying a home and I'm coming into a lender, what can I expect as far as that interaction, and what can I hope to get from that, and what is kind of the norm versus how Art does it at MortgageWorks? And his information is on the screen, 760-969-5023. Before we go, I want to bring this up because you mentioned it at the beginning, Art, about it's hard to even talk about, but the tragedy with the fires. And I'm going to bring this up. You talked about this. I'll kind of bow out. Please talk about this.
Yeah, thanks, Jeff. I do want everyone watching and listening to the program to understand that the mortgage industry is already rapidly responding to what's happened in Southern California with the wildfires. This information that we're posting right here is from Fannie Mae. And what this underscores is the fact that Fannie Mae has already announced for both homeowners and renters that there is help if your home's been destroyed by the fires, if you had a mortgage, and that there are ways that you can get forbearance and get some help with making that mortgage payment. For example, Fannie Mae can offer a forbearance of up to 12 months, so you don't have to make any payments. You won't be charged any late fees. It's not going to affect your credit, and so forth. And all the major mortgage agencies are doing this. Fannie Mae is doing it. Freddie Mac is doing it. FHA is doing it. VA is doing it. A lot of the major banks have already stepped in and are offering ways to give you some relief if you have a mortgage on an existing home that was burnt down. So don't feel like you don't have options. In this particular case, we've got a phone number here that you could call if you're a homeowner or a renter, to call Fannie Mae to get more information and get counseling as to how to recover from this disaster as it relates to your mortgage. Now, understandable, Palisades, there's a lot of multi-million-dollar homes there. It is probably true that a lot of those homeowners, if they did have a mortgage, may not be Fannie Mae loans because the loan amounts are higher than what Fannie Mae purchases. But understand too that if they have loans that are jumbo loans that are held by any of the major banks, you probably have some options. So I would encourage you to seek out that information, contact your lender, because the industry has reacted very rapidly to provide that kind of information, so you don't feel alone and lost and are fretting about what to do with that mortgage that you have in place that was secured by a home that's no longer there. So hopefully that you'll find that reassuring, and I would urge you to get that information as soon as you can. And because even then, after the forbearance is done, there are additional options that these agencies or these banks can provide you to help you get back and recover from this just terribly devastating fire that we've had here in Southern California. And then lastly, I want to just point out, next week, one of the things we're going to talk about in our discussion on the Mortgage Minute is I'm going to talk a little bit about unpaid medical debts and how those are no longer being reported to the credit bureau, so that could help you with regard to your credit scores and no longer affect you adversely when you're trying to get a mortgage. So that's something we'll talk about on next week's discussion. So with that, I want to go ahead and conclude this week's Mortgage Minute. I want to thank you all for watching and listening to the program. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Try to have a good weekend, and we'll see you next week. Thank you. So long.